the bigger, safer companies are going to be the last ones to decline.
Yep.
So there comes in that sort of mirage. People think about tops as being sort of manias, but really it's almost like you have a paradox at those points where it looks like that on the surface. But what actually is happening is people are reining in their capital, meaning they're distributing it on a discretionary basis. They're basically saying, well, I'm not so sure about all these other companies, but I am really sure about these big, strong companies that are just going to be around forever. And they're just printing cash flow or whatever. So we're just going to buy those and we're going to sort of trim on the other side. But the net effect of that is it leaves your patient, the market is your patient, really vulnerable to any external threat.
Welcome to the Advisors Fuel podcast, where high-performing financial planners and wealth advisors discover proven processes and actionable strategies to elevate their client experience, grow their businesses faster, and achieve unprecedented success. Here's your host, Adam Koós, founder at Adrenaline Advisor Consulting at adrenalineadvisor.com.
Welcome back to the Advisors Fuel podcast. Today, we're going to get a little nerdy and dive into something most advisors want to implement within their clients' portfolios, but rarely know how. Or at least they don't know the best way to do it, and that something is risk management. But I'm not talking about annuities and income benefits here. I'm talking about real risk management, like, for instance, getting out of the stock market when it's in the midst of a crash. So I'm joined by my friend and fellow market technician, Vincent Randazzo, as we break down how rules-based, technically driven portfolio management helps advisors manage and protect their clients' portfolios during drawdowns and those catastrophic market crashes we all want to avoid. We also talk about understanding what's happening beneath the surface of the market and how to cut through the noise that is the financial media. So we run through market breadth, drawdown control, and why having a repeatable process matters just as much as performance, especially when markets get choppy, because without a simple, repeatable process, well, your clients might not like their performance, especially in the middle of a bear market. So if you want a clearer way to communicate risk and lead clients with confidence during uncertainty, especially during uncertainty, well, this episode is for you. So enjoy my conversation with Vince Randazzo. All right, everybody, welcome back to the Advisors Fuel podcast. We've got a chart nerd treat today. We're actually recording this almost on Halloween, actually. It's trick or treat tonight. But I always call every November for me, I call it Nerdvember. And I've been doing it for years. So for Nerdvember, today our first guest is going to be Vincent Randazzo. He is the founder of View Right Advisors, where he builds systematic, technically driven investment processes to help financial advisors navigate market cycles with less drama and less worry, and then, of course, tighter risk control for their clients. Before launching View Right, Vince led technical research at Lowry Research, which is now called CFRA, by the way, collaborating with legends like Sam Stovall and one of my personal mentors from early in my career, the late Paul Desmond. I actually have a picture of him on the wall hanging behind my desk here. But Vince's work has helped identify key inflection points across multiple market cycles. He's also been featured in Bloomberg, NASDAQ, MarketWatch, Proactive Advisor, and of course, he's a part of the CMT Association. So today, we are digging into one of my favorite nerdy subjects in portfolio management: how to build rules that defend your client's capital, adapt through the crazy stuff we see on TV, trend changes in the market, and help you communicate risk and diffuse the financial media drama like a pro. And again, because it's Nerdvember, we're definitely getting into the weeds on purpose. So Vince, this has been scheduled for more than 6 months now, I think it is. So it's already here. So thanks for hanging out with me today.
Of course. Yeah. Thanks for having me, Adam. And I have to say, I'm honored to be your first nerd in Nerdvember. I really am. So thank you for that.
You were so welcome.
That distinction, right?
Sometimes I wonder, like, why would anybody want to hear two nerds talk, right? But anyway.
Because you might learn something.
Maybe. We'll see. We hope so, right? So
Yeah.
let's have some fun here. I'm going to start at the very beginning. You've worn, obviously, many hats, from Lowry to running your own shop now. What made you want to build your own process instead of staying inside the big research world in the, metaphorical corner office downtown?
Yeah, it's a great question. I mean, started my career 20 years ago, more than that, actually. I started in 2022. Goes fast. And, after that amount of time of studying market cycles, investor behavior, and working with financial advisors, in all my roles, I kept seeing the same main problem. It's that people, not that they don't understand risk, it's that they don't have a process for actually managing it. And worse than that, they're taught not to even try, right? So that's what led me to build Defender, and I just felt like if we can systematize what those sort of impeccable instincts that very few advisors have, if we can somehow systematize that and back it with data, um, then that's where the value is going to be, and then deliver it in a way where it's just easily digestible. We don't have to sort of go through all the nerdy stuff to them. We just have to tell them, here's why, in very plain terms, and here's what you're doing with this information.
Right. I've got to find this quote because as soon as you said that, I immediately thought of this quote, and I'm trying to think, who did I stump? Was it Ryan Dietrich? It was somebody like us, somebody who's in this industry. We nerd out on charts all day. Here's the quote. And I want you to tell me, and it's okay. So far, it's nobody has guessed who said this quote. So if you Google it right now, you're cheating, by the way. But
Okay,
here's the quote.
hands up, hands up.
All right. Naturally, the disservice done students and gullible investment professionals who have swallowed efficient market theory has been an extraordinary service to us and other followers. In other words, the big money, the smart money. In any sort of contest, whether it's financial, mental, or physical, it's an enormous advantage to have opponents who have been taught it's useless to even try.
I know this is wrong, but I'm going to say like Bogle because it's very serves them very well.
Sure. Yeah. No. It's Warren Buffett.
Ah,
Isn't that crazy?
okay,
So
that is crazy.
what I love about that, I found that. I shouldn't say I found it. It was Tommy Dorsey who gave it to, who taught me that it existed. I think he said it back in 1986. But I mean, the mutual fund companies out there, ETF companies as well, the only way they get paid is if you don't sell, right? I mean, you got to stay invested if they get paid. So it just, obviously that quote's been buried because of all the Warren Buffett disciples who think that he never sells and that he stays invested all the time, which just isn't true, first of all. And then second of all, there's the fact that Warren just goes out and buys the whole damn company, right? It's not like he's buying shares like the rest of us.
We
But
can't get deals like Warren. Let's just say.
right. I would argue that most financial advisors say that they manage risk for their clients, but very few, as you put it, have a framework, a systemized process, we'll call it,
Right.
for doing it in a repeatable fashion on a day-to-day, week-to-week basis. So when did you realize that gut feel wasn't enough, and then what pushed you to systematize your?
I would say it started right around 2008. And like you, and I've read your story too, which is really compelling, kind of similar to mine in a lot of ways. Starting my career in 2002, in the face of a major bear market, right? It sort of frames the way you think about things, especially risk and drawdowns and the numbers that are associated with those drawdowns, right? 50% drawdown takes you 100% to get back, right? I mean, it's just math. That's just how it works. And then going into, fast forward to 2008, another big situation where, I saw, I was working with Peter Lee, who was a technician at UBS at the time, and I was working with financial advisors, and had been making the case that, hey, the market looks really vulnerable here for a top. This looks like it could get really ugly, and sure enough, it did. And I just said that it was not, there was no system around that. It was just we were seeing these signs, but we couldn't put a timing element to it, right? And that's what kind of makes it fall on deaf ears a lot of times. It's like, okay, you sort of feel like it's the boy who cried wolf in a lot of ways, right? If you are seeing these things, you're seeing them for a long time. Usually that's how it works. Major market tops usually take a pretty good amount of time to play out.
Oh, yeah.
So, that was part of it. And then working at Lowry, it was sort of that final icing on the cake where I just gained this very deep appreciation through Paul Desmond, for what market breadth really tells us about the market. Um, because the major indices are mega cap skewed for, certainly, but they're all market cap weighted for the most part, except for the Dow, which is price weighted, weirdly enough. Um, Basically you have these mirages that could take place in the market where things might look really great on the surface, where under the surface, not so much. In fact, not at all. And major market tops, if you look at some of these numbers that I look at, it's like, how is this thing even standing anymore? It's almost like you take a stool and you removed two of the legs already, but you're like, how is this thing still standing? Right.
Yeah, I like to compare it to, just because I was pre-med in college, I like to compare it to somebody who on the surface looks completely healthy outside, but
Yes.
inside, there's like multiple cancers brewing and you just don't know it, it's scary. Well, tell me this. So describe what you're doing with your investment philosophy in a nutshell.
So in a nutshell, I realized that most of the tools that big institutions use to manage risk just weren't available to independent advisors. So I just basically set out to bridge that gap. I just said, well, why don't we just try to manage money like the big boys manage money in a way that is better for them, better for their clients, not only financially, but sort of emotionally, psychologically, behaviorally, right? And that's what really it's about. It's about getting the market view right. That's essentially what it boils down to. So just keeping it very simple. That's the goal here.
I see what you did there. View right. Yeah.
Yeah, you get it right.
Yeah,
And
exactly.
also my initials, Vincent Randazzo. You right.
I didn't catch that. That's
You
fun.
got that?
Yeah, okay, and I see, yeah, very creative. All right, walk us through your program that you call the Defender, the Defender program. What are the moving parts? How does it decide when to, dial risk up, dial it down in the markets, depending what the market.
From a sort of philosophical standpoint, just like markets evolve, so is my own work. Just like yours, I'm sure.
Sure.
And Defender came out of that same idea, adaptation. Whether it's portfolio or businesses, the key to being in this game long term is the ability to adjust without losing discipline. Right? I mean, it's why humans dominate the planet, is because we're able to adapt really quickly and and smartly over time. So that was sort of from a top down big picture perspective. That's what I would say. And effectively, what we're doing is we're looking at market internals. I use various flavors of the advanced decline line, and the advanced decline line, for people who don't know, is simply the running tally of how many stocks are going up versus how many stocks are going down every single day. So the idea is that the more stocks you have going up every single day, the healthier that market condition is. Meaning, for a portfolio manager perspective, it's much easier for you to pick a stock that's going to go up, right? And it's probably much easier because of that. It's much easier for you to pick a stock that's going to actually outperform. So, in a way, that's sort of the basis of it. We also have, of course, time and magnitude and threshold transformations, I'll say, on those indicators. Also, percentage of stocks above their long and medium term moving averages. How many stocks are in uptrends? It's an important thing to know. Um, when you look at major market tops, usually that number is a lot lower than you think. In fact, it's almost like you have this escape velocity type situation when it comes to some of these indicators, where once they actually get really high, because they're bounded, they're bounded by 100%, right? I mean, you can't go any higher. Once they go really high, they tend to sort of just move sideways for a long time, and that's okay. But
Mhm.
it's when they start to really diverge and you get the divergences in the advanced decline line that tell you that, okay, on a day-to-day basis, there are more stocks actually going down than are going up. That's problematic because it just means, again, as a portfolio manager, if your portfolio doesn't reflect that market cap weighted index, then it's going to be a problem for you. And the reason why it doesn't at tops usually is because the market cap weighted indexes are market cap weighted. And this is something that Paul Desmond pointed out so smartly and, so many times, is just that the bigger, safer companies are going to be the last ones to decline.
Yep.
So there comes in that sort of mirage. People think about tops as being sort of manias and, evidence of euphoria, but really it's almost like you have a paradox at those points where it looks like that on the surface, but what actually is happening is people are reining in their capital, meaning they're distributing it a little bit more on a discretionary basis. They're basically saying, well, I'm not so sure about all these other companies, but I am really sure about these big, strong companies that are just going to be around forever. And they're just printing cash flow or whatever. Um, so we're just going to buy those and we're going to sort of trim on the other side. But the net effect of that is it leaves your patient, the market is your patient, really vulnerable. Um, to any external threat. So anything that happens on the outside, whether it's news or earnings or Fed policy or inflation or whatever it is, you're just at that point so vulnerable. So really what I done with Defender is you're transforming risk management from intuition to discipline, data-driven process, which is going to preserve compounding, reduce your behavioral risk, right? And strengthen client trust. And of course, the end result is the advisors will make more money and so do their clients.
And protect them from drawdowns, which is almost more
Right.
important.
That
Um,
that's that's absolutely it. Yeah.
I was really glad you mentioned Desmond again. So is it safe to say that he was one of your mentors as well?
He was. In fact, he was the reason why I took the job with Lowry. I mean, I basically wanted to be able to focus expressly on technical analysis. It's something in my career before that I had never done. I had my CMT. I got it in 2008. But it was always like I was melding together. I had this background. I'm an economics major. So I had this background of sort of being able to piece together the sequence, right? The econ to the strategy to the sectors, to the market, to the fundamentals, to the stock level. And then I just had this extra piece that I found really useful and helpful in differentiating myself in my career and also in speaking to my clients and doing best for them, which is technical analysis. It just made me that much better than everybody else. But it's something that I was fascinated the most with, and I really wanted to dive into that. So working for Paul was instrumental in that because I could just walk into his office, and I did every single day. I made a point to walk into his office and have a conversation, and I didn't know where that conversation would go. I would just ask him a question that I thought was really smart, and then he
You
would
hope so.
just,
You
yeah,
hope it was smart, right?
yeah. Well, I thought, like I said, I thought, right, and most of the time the way he explained something, it made me rethink what I had thought in the past,
Yep.
and he gave me another something else to think about, right? So really, it drove my own curiosity in a way, just being there.
Yeah. Well, couple things. First, I believe it was speaking of technical analysis. I know that many advisors think of it as voodoo because that's what we're all taught in the beginning. They call it timing the markets, and we'll talk more about this later. But I believe it was Frank Texiera who, at a conference once, I was mentioned that technical analysts are the lepers of the industry until the market starts going down. Then everybody wants them on CNBC, right? So when the market's going up, nobody cares, nobody's calling. But when shit hits the fan, now let's get a technician out here to figure out what's going on because we don't know what to do because all the CFAs and the analysts out there are just saying it's a better value now than it was because it's worth half as much, right? So that's the first thing, and then it was Desmond. The reason I asked you if you would consider him a mentor of yours as well, I'll never forget. He was the first person that described to me this whole concept of market cap and that the S&P 500 is weighted by its biggest companies. The NASDAQ is weighted by its biggest companies. The Dow is nothing but big companies. So using our health analogy again, that you don't really start to see the effects of disease underneath the skin until I don't want to say it's too late because that's not the direct analogy here, but like the human body and health and disease, it's the small caps, the small companies that start crashing first. And what happens is the big institutional money, the smart money, the mutual funds, the ETFs, but mutual funds especially, hedge funds, they start selling those small caps, which drives prices down even faster. And then they start buying mid caps. And then eventually when those trends break down, they start selling the mid caps, which send the mid caps down. And then they start buying the large caps. And because of this cascade, or call it reverse cascade effect, what you end up with is major market indices going up while 60, 70% of the market's going down, but you can't see it. You don't have an x-ray, right? But you do. And so that's my next segue here. How do you balance keeping your model, the Defender model, robust, data-driven? Because this is complicated stuff. So how do you do that without it being so complex that, the average financial advisor realistically could?
Great question. And me having worked with advisors for 20 something years, I understand the need for simplicity. I made similar observations over my career. Too busy. You guys are just too busy. You're doing too much. Wearing too many hats. you're getting overloaded with information, right? Which leads to analysis paralysis, and you just don't know what to do, basically. And again, just a lack of process. So I wanted to deliver a simplified solution. I sort of just want to give them the answer. So I don't want it to be so interpretive. I want to basically say, okay, I've looked at 100 and something years worth of data. What I've learned from that data, this is what I've learned. When these conditions are in place, historically, this is your expected return profile. Here is your expected volatility profile. Based on that, right? Here's how you would be invested, right? And so it's very simplistic. Either you're 100% invested, 66, 33, or 0. That's it. That's our only choices, right? And it's very clear, very straightforward, and it's all data driven. No emotion.
Talk to me about drawdown control. And when I say drawdown control, to people who are newer in the business and haven't even been taught a thing about technical analysis, trend following, tell me about how, or tell the audience how you protect, or how the defender, which obviously the what it does is in the name, right? Like we call our portfolio management process, our trend following models, defense first. It's the whole Bear
Mhm.
Bryant's, offense sells tickets, defense wins championships. So how does the defender program control drawdowns, market crashes, those catastrophic things that wipe out, half of the country's net?
We're ahead of it is the answer, right? Because we are looking under the surface. Our X-ray is on all the time, right? Um, so we're looking under the surface all the time, and we see when that fragility builds to a point where historically it breaks. So, and I'll give you an example of what the timing of that could be. Um, in February of this year, it's actually February 24th of this year, we had a sell signal. It said sell 1/3, right? So it's very exact, very precise. And here are the reasons why. And we went through all, the reasons why, and here are the probabilities going forward. Probability is that we're going to get another sell signal. Probability is that this is going to be a drawdown um, of X percent, and we keep it very very directive in that way. So really, what we're doing is we're providing signals to advisors, not more noise. They don't need more noise. They don't need more 50-page reports or primers. They're not going to read them. That's just not where what we live in that kind of society right now, with information so fast, so concise, so short. I mean, Twitter, um, whatever, all these platforms, it's all very direct. And the difference, though, is that instead of being sort of opinionated about it, this is all factual. It's all objective, and there's no fluff, and there's no need for me to write this every single day. This is when you need to know. We'll let you know.
And I love your line, we don't predict, we prepare. It reminded me actually of how at our office, we always say to our clients, we're not trend predictors, we're trend followers. There's a difference.
Right.
How do you make that click for clients, or whether that be clients being your advisor clients, or how do you communicate to them how to make that basically sink in with their clients in the middle of a storm?
Trend following is great when it comes to individual stocks. That's when momentum works really, really well. When it comes to the market overall, because of the market cap weighting situation, that's not always the best way to do it, right? Because at tops, you have this this gap of misinformation, right? Where momentum actually looks pretty good, usually, at least in the major indexes, but ultimately it isn't under the surface, right? So we actually try to be, I wouldn't say, we just try to be ahead of the change, identify the vulnerability for a major trend change. That's what we're focused on. So it's not short term at all. In fact, the goal is a smart buy and hold here. It's that we love buy and hold. We love passive from a lot of different angles, and in the sense that stock picking is really, really difficult and really time consuming and low probability outcomes, at least on a risk adjusted basis. So passive investing from that perspective is, to us, it makes a lot of sense for a lot of people, even advisors. But what doesn't make sense is is having no risk management process. So if you combine anything, whether it's active portfolio management or passive portfolio management with active risk management, then you have something. Because then, like you said earlier, you're avoiding those huge drawdowns, and that has a tremendous effect on compounding. We all are taught, every single person knows this, 9% a year, that's what you get.
Hmm.
That's the average. It's like, great, that's the average. But if you've ever done any kind of mathematical problem, when you have negative numbers involved, the order matters, you know? So if I give you three numbers, let's say 999, yes, that averages to 9%. Well, something else that averages to 9% minus 30, 27, and 30, right? Also averages to 9%. So the difference, though, from point to point is about half, right? In the second outcome, you get about half. So imagine, as you're getting later in your sort of life cycle toward retirement, or you're in retirement, um, that sequence matters. So this is kind of addresses that point of sequence of return risk, right? And that your ability to take a drawdown when you're 70 years old is much different than your ability to take that drawdown when you're 30 years old. And then you add to that the other thing that we can't control, which is where we are in a secular move, right? So within this secular bull market, where are we? Well, we're not at the beginning. I know that. We're probably closer toward the end. So if you combine those two things, where we are in that long cycle and where you are in your own personal journey toward retirement, it really matters when you take those drawdowns.
Totally.
So if you can minimize, then that's the best that you can do. Minimize or avoid at any point in time is great, but especially at those points.
I love it. That's I've got three things for you. We could do this for an hour and a half, easy.
I'm sure.
The first is I don't know how sometimes I weave in song lyrics into these episodes, but my thought with buy and hold investing, never having any risk management, it's like the Outcast lyric. You can plan a pretty picnic, but you can't predict the weather. So there, we got Outcast into this episode.
Nice.
Second, whenever we talk about sequence of returns with our clients, whenever we talk about averages, and it's like, okay, 9% sounds great, just put it all in stocks, right? Put it on the NASDAQ. That makes the most money.
Right.
But I always talk about the guy who drowned in a river that was an average of 4 feet deep. And that's the
Uh-huh.
joke, right? That is the
Uh-huh.
joke. So think about that for a second.
Right.
And then lastly, clients just want two things. And I think this is what they know they need this, and they know that there needs to be a solution for it. And that's what technical analysis was for me when I started using it back in 2008, is they want to know that they're going to be okay. And that's the financial plan. Like, am I going to make it to retirement on time? Am I going to make work optional when I'd like to have the choice to? And then and obviously, if I'm already retired, is my money going to last longer than I am? Right. The second thing they want, though, that I think most advisors don't have a plan for, is when the market goes sideways, when we hit recessions, when we hit market crashes, the clients want to know, what are you going to do about it? Like, are you paying attention? What are you doing? How are we going to deal with this? And if you don't have an answer for that, not only is it necessarily not going to make your clients the happiest in the world, but it's going to make your life extremely stressful to literally say, well, the house is on fire, but we just don't have a plan.
Right. Oh, that's such an important point. And I wish more advisors paid attention to that and took that as seriously as you obviously take it. I talk to a lot of people who are my age, of means. Yeah, I'm in my mid 40s, who are, reasonably successful. We live in an affluent area, and you talk to them. And I always try to needle them a little bit, and we always kind of get to the same expectation. They actually do expect, whether they say it or not to their advisor is a different story, but they do actually expect them to protect them ahead of drawdowns or in drawdowns. They absolutely expect that, or at least, like you said, have a plan, right?
Yeah.
It's so overlooked, and I think after, let's just say, 16 years of relatively easy times, that's been lost, I think, on a whole generation of financial advisors. It is probably the point here.
Yeah, I think that most clients don't want us to beat the market all the time. I mean,
Correct.
but I do think that in financial advisors' defense, because, I was taught the same way when I started my career, September 1st of 2001, 10 days before the World Trade Center went down. They're financial advisors. We are not taught that risk management, we're not only taught that risk management and technical analysis is an option, but we're taught the opposite. We're taught that it's BS, it's voodoo.
Right.
So we almost come into this thing like, here's a solution. Somebody tells us, I've got a solution for you. Like, it's not going to work. So you come into it with this bad attitude. And I think we all need to have more open minds. I mean, I know it changed my career, changed my life. I mean, I was ready in 2008, halfway through 2008, I was ready to sell my firm and do something else or,
Mm.
or change how I manage money. Because
Yeah.
I couldn't sit in front of a client anymore and say, and regurgitate the one-liners that I was taught by national brokerage firms, like, don't worry, you haven't lost anything unless you sell it. Or, it always comes back. Look at this
Mm.
80-year mountain chart, even though you're not going to live for 80 years.
Right.
So my philosophy changed to, you haven't made anything unless you sell it, right? But
Yeah.
give us another story. So you mentioned, I appreciate you mentioning earlier that, kind of how the Defender program worked, how, February, I think you said 23rd. I was looking
Yeah.
at a chart here. You go February 23rd, we've got a descending, 50-day moving average, descending 20-day moving average. Market's kind of starting to hit new lows in the short term. Give me another story of another time in history where market breadth, leadership, the things you're talking about affected the program and how the Defender framework.
Yeah. So, obviously I went through history and I back tested the program. So we started in live this year in January. But, another fascinating time was in the late 90s. And I just think, and I bring it up just, I think there are some parallels. I don't think there's a bunch, but I do think there are some. And I think it's really interesting. I think breadth back then was a lot worse. But 98, you had uh, pretty decent divergence that led to a huge drawdown. You had the long-term capital management, you had a few different things going on there, and there was a short-lived drawdown. It was recovered very quickly. It's kind of like, reminds me of what happened in April.
Kind of like the tariff crash, right?
Yeah, exactly. You had the sort of the trappings, historically sort of had the trappings of a major market top at that time. Same thing early this year. Had all the trappings of it. But it didn't sort of coalesce in that way because there was just too much of a bid and there's too much interest in these big mega cap names, and for a lot of other reasons. And then into the high in 2000, there was, I wouldn't say it wasn't like a lockout, but certainly there weren't many opportunities to buy dips, right? From that point in 98, from that low in 98 all the way until like probably the middle of 99, and then you started getting some drawdowns. But our program didn't have any tactical buy signals. It does have a tactical program within the context of a healthy bull market. It will systematically also buy the dips, tell you when to buy the dips, right? But it didn't have that. It didn't have any opportunities to do that. And in fact, by the end of 99, September of 99, we had the last sell signal, right? So that's why I said it's not trend following. It's not trend predictive because that's not what we're doing. But we are sort of very risk aware when it comes to breadth and historical context when it comes to these types of environments. We want to identify, this is the environment that we were seeing now. Here's how it played out in history when this set of circumstances were in place. Here's what we need to watch for.
Yeah, it's like that's where again the disease started to multiply under the surface, right? The small caps, the mid caps start going down, and then you get a 24-month drawdown of 47%, which is a whole lot easier to look at on a chart. Looking back, and then same thing with the 2007, 8, and 9 crash, which was about 18 months, but 57, almost 58% drawdown. It's so easy to look back at that chart and go, whatever. But in reality, living through it, like
Oof.
many people did, the market peaks in, 99, 2000, and it goes nowhere until April of 2013. 13 years of nowhere.
Yeah.
And that's where I like to talk a lot about, and you can rip on this if you want, but I always like to talk to other portfolio managers and people who like nerding out on this stuff about, when you think about it, age, like when your birthday, when you were born, in order for you to have lived through and even remotely understand what it's like to live through a true market crash, not the COVID crash, not the tariff drop, not flash crashes like 2010, March of 2010, I believe it was, but I mean a crash, a real crash. You have to be at least 45, 46 years old. And the reason I say that is because, first of all, you got to get to an age where you have a job. And even if you have a job and you start putting money into a 401k, you probably don't care about that balance of that 401k all that much until it starts getting bigger. And so let's just say you have to wait until you're maybe 30. Is that fair? At 30 years of age, you maybe have a portfolio that's big enough that you care if it goes down, like it bothers you, right?
That's fair.
And then
Yeah.
it's been 16 years since the bottom of the last crash. That's 46 years old.
Right.
Isn't that
Yeah.
crazy?
I think that's great. It's great to think about it that way. To me, it brings up this idea of lost decades, and there have been many, many through history. You go back all the way to the 1800s. You can track them, and usually they're not just decades. It's not just like one distinct decade.
Mm,
It's usually like 15, 20 years in some cases, where you just have a huge range bound market. Where I mean, can you imagine
huge,
that now? I mean, can you
huge,
imagine
multi-years. Yeah. I mean,
multiple years of just uh, getting rallies and then getting crushed by a 30% decline and then a rally again and then get crushed by a 40% decline. I mean, that will set you back no matter who you are. If you're buying and holding in that situation, I don't care if you're buying the best dividends companies in the world. That is not going to be pleasant for you.
yeah.
And I remember in 2013 or 2012, 2013, 2011, there's a lot of talk that buy and hold is dead because it was. It was dead. I mean, it was dead for a whole, for 13 years by that point. So it was true. But there's going to be another time because there has been historically, again, this happens every couple decades or so, where you get a lost decade. And when
I've
you
got
get
a,
those, you know,
I've got a high schooler and a middle schooler, and the cool songs and the cool stuff going on in high school doesn't hit the middle schooler till like a year later. Like they're behind, and I think it's the same in the market. I think that we get so confident, because the market goes through these periods of exuberance, and I'd like your opinion on this, by the way, but because I don't see a market crash here in the near future. Like I just don't see that happening right now. I think it's going to happen, and I think we're going to have another long period. We're looking at 16 years now, and that
right,
the market goes through these secular, not cyclical, but secular
right,
periods of sideways, absolutely nowhere but choppiness, like it did between 2000 and 2013. And then it goes through bull markets, secular bull markets, right? Where it goes from 2009 to where we are today. And at some point, we're going to start seeing those signals. And I can't remember who said, I think it was Ryan Dietrich says this. I don't want to steal it from him, but every correction starts with a pullback. And then every crash starts with a correction. And then every catastrophic crash starts with a bear market, right? Your run of the mill 20% bear market. So what is your take right now on the market? Given all the news, the noise, financial media, they're always trying to scare everybody every day. And every 4 days there's markets in turmoil, right?
yeah.
So what's your thought right now?
I would say right now we are in a position that I don't see a major market top. The defender is not looking for a major market top here. We are watching some breadth divergences and some staleness since probably about the middle of September. I think is pretty fair to say for a lot of the indicators that we watch. So it wouldn't be surprising to see some sort of a more near term type correction, but not the end of a secular bull market, right? Not even probably a major market top at this point. But I agree with you that it's out there on the horizon. We don't know when, and that's why we need a process, right? We just don't know when. We need a process to identify it ahead of time before it's too late, and then a process how am I going to ride it out? Like you said, how we're going to deal with that if it happens, right? Uh, so I think if we can be ahead of that, it is so tremendous for clients to hear, and I think it does wonders from a trust perspective that, hey, you've been through this before. You've actually been forged in fire. I mean, you specifically, Adam, right? I mean, the way you started your career, the way I started my career, yeah, you're forged in fire. You had to adapt to that situation so that it doesn't happen again, right? Or at least you could do your best so it doesn't happen again.
I'm fortunate to have started when I did. It wasn't fun. It wasn't fun being 21, 22 years of age, 60 pounds lighter. I look like I was 16, trying to convince people 3 times my age to trust me with their life savings when the market's precipitous. But I will say that, I would like to plead that, not that financial advisors start adopting technical analysis as their main and, only strategy they implement at their practice, but that they add it to their practice, as because that's what we do at our office. We have strategic models and we have trend following models, because there's markets like the COVID crash. There's markets like the tariff crash, where when you look back, sometimes it's you're not going to get in lower all the time, right? When you get out, you're not always going to buy in lower. There's whipsaws out there. I always like to compare it to tornado sirens. And at least in Ohio, maybe not in Oklahoma, but in Ohio, maybe there's 7 tornado sirens before you ever actually get a tornado to show up. So most people think, I'm not going to go to the basement, and we do that in our portfolios too many times. It's like the tornado siren that cried wolf, right? And then all of a sudden something happens and you wipe your house out and people start dying. So I'm just pleading to financial advisors that they at least have an open mind to stuff like this. Look at technical analysis, look at risk management, because again, not only does the average investor have to be at least 46 to even know what it feels like to be in a market crash, but so does the average financial advisor, right? Or at least somewhat, maybe call it maybe 40. Well, because, if you were in this business during 2007, 8, and 9, you know exactly what it feels like to be counseling clients through a catastrophic crash. So again, I'm glad that you shared your opinion. I think we both agree that, even if the market corrects over price or time, it's going to be a correction, probably not a crash. But at some point it's going to happen. And I just hope that advisors put something in place ahead of time, instead of just waiting till they're stepping on a landmine and they're going, "Oh, what do I do now?"
Yeah. Yeah. I think it's such a great point. And I look at it as this: why not have insurance for your biggest asset, or your book of
There we go.
business and all those personal relationships? I mean,
There we go.
that's something that can go away in a heartbeat if you don't have your eye on the ball, right?
Well, let me tell you, a not so secret is that not only is having technical analysis on your side beneficial from the standpoint of counseling clients, doing something, adapting to the markets. That second piece, like, what are you doing about it? Like, actually having a plan. Not only is it great for that, but truth be told, when from your most conservative to your most aggressive client, when markets go down, let's just say 40, 50%, your portfolios are going down 25, 30%, and so is your revenue, right? So,
Right.
I mean,
Right.
it's not a conflict of interest. You are on the same side of the table as your clients, and you have a vested interest in protecting them from catastrophic market drawdowns. So, to close out today, never done this before, but we're going to do it with you. To close, we're going to call this the Nerdvember lightning round.
Okay. I'm
So,
gonna do my best here. Let me see.
one chart you would show a financial advisor, or a client for that matter, who says, "I don't need technical."
I would show them the New York Stock Exchange all issues advanced decline line versus the S&P 500.
Okay.
Going back, I would take it back 20 years, right?
Yep.
Let's just say, let's say like,
Go 25.
let's 25, because we want to get that big crash in there.
Yeah.
And I just want to just point out, here are the warnings right here. These big, long divergent, those are the warnings. This is telling
Yeah.
you what was going to happen next, right?
Yep.
That's one thing I would show.
All right, look that up, financial advisors. Trust me. Put the S&P on top, or the NYSE on top, and put the advanced decline line below it. Second question: what's your favorite one pager or visual that instantly calms clients?
Well, I'm in a little bit of a different position that you guys are in, but I think that the one thing that usually will um, kind of assuage some fear is just demonstrating a difference between what you can do in a major drawdown and what can happen in a major drawdown. So, like you said earlier, okay, if you get a 40% drawdown and then your portfolio is down 20, like that's a big win. That's a huge win, right? You're talking about a huge mathematical advantage there for your future growth power and your future compounding. And how does that work out over 20 years? I mean,
Oh
the
yeah,
math is tremendous.
exponential, right? If an advisor had time to check, let's just say 3 things, it could be 5 things, but say 3 things every single week to stay aligned with the market, what would those 3 things?
Plain old price chart, I think, of let's just say the New York Stock Exchange composite, just easy. I don't want to be too, one way or the other way. I think that's just a great price chart. I also like to look at the different flavors of breadth. So I would look at breadth for the advanced decline lines for the S&P 500, S&P 400, which is the mid caps, and the S&P 600, which is small caps, right? So those would be the ones I would really want people to look at. And then I would also say, look at the percentage of stocks if you can. And Optum is great. It's one of the platforms that I use. But they're able to visually, you can depict very easily in one chart how many stocks in the Russell 3000 are above their 200-day moving averages, 50-day moving average, and the 20-day moving averages. Great chart.
Yeah, that's great. I love that. Sounds like a good pre-flight checklist to me. So, stealing that. So, for the next generation coming up, if you could give them one habit to build and one constraint to respect, what would those two?
I think discipline is a habit. I think it's so rare to have discipline in everything. But if you can demonstrate discipline in the way that you approach that fiduciary responsibility that you have as an advisor, right, to protect and serve your client, to me that's tremendous, right? And the second one, I talked too much, so I forgot the second part of
You're
that.
fine. Second is what's the biggest constraint, or say one constraint to?
I would just say that you're not going to get them all right, especially when it comes to a system. You're not going to get them all right, but if the odds are tilted in your favor, still you're ahead of the game.
Just want an edge. Yeah.
Yeah.
Two more questions. First, what is the biggest chart crime you see people committing in your day-to-day work? So, and for those of you who don't know what chart crime is, we in the TA world, the technical analysis world, we all have, on Twitter, let's just say, I guess it's X now, somebody will post a chart and we'll look at it and we'll call it chart crime. So, give me something.
Yeah. I have two that are really, really offensive to me. One is the lack of a logarithmic chart, right?
Yeah.
That's one. And number two, and this is like, I don't even know why people think this is okay to do, but no identifier on the x-axis, right? If I don't know what time frame I'm looking at, what is the use of this thing?
Right.
Right?
It's all fractal, but is it weekly? Is it monthly? Is it
Yeah,
3
that
minutes?
kills me. Those two things kill me.
All right. Well, finally, what do you think is the single biggest benefit that would be to financial advisors to implementing a process like the one that you've been describing today?
The biggest benefit, and there's a lot of them, but I would say, to me, it's confidence.
That's exactly what I was going to say.
Confidence, and I think confidence instills trust, right? And trust just is going to be something that, again, you earn that. You earn that over time through consistency, through preparation, right? And that's something that is tremendously valuable. You cannot put a price tag on trust.
Yeah, that's awesome. Well, the audience that's listening, watching, you all know that, I've been a market technician for a long time. You know that I manage all my own model portfolios. You also know that I have zero interest in managing money for any other advisors. I have no interest in doing what Vince does. So if you're looking to add technical analysis, add risk management, add a facet to your portfolio management process in your office for your clients that includes risk management and protection, especially during the inevitable catastrophic market crashes, check out Vince. All his contact information, website, email, socials are gone in the show notes below. And for advisors who want more clients, better systems, and a scalable way to make decisions under pressure, our Adrenaline Advisor Consulting Program is open with an on-demand webinar where I share some of our secrets on how we've grown a 7-figure practice and beyond. You'll also get an hour of CFP CE credit for watching. So worst case, you learn some great prospecting systems to grow your practice and walk away with a little bit of CE in the process. But we also have 2 monthly Q&A calls that are live. You could RSVP and attend those where there's no agenda, just advisors chit-chatting about the Adrenaline course and community to see if it's a good fit for you, so you can bring questions, see behind the scenes and again, decide if it's a good fit for your practice. But you'll find all the registration links for that and dates in the description. And again, if you'd like to even just ask Vince some questions and learn more, again, his email's down there. You can contact with him or connect with him personally. So thank you so much, Vince. Appreciate you being here. And thank you all for taking a little bit of the Advisor's Fuel today. And happy Nerdvember.
Thanks for having me, Adam. I appreciate it. It's been a great conversation.
Same. Yeah. We'll talk soon.
Thank you for tuning in to the Advisors Fuel podcast. For more articles, videos, and resources, or to schedule an intro call, visit adrenalineadvisor.com. This podcast is for informational purposes only and should not be relied upon as a basis for financial or legal advice. Always talk to your compliance department before implementing any of the ideas shared in this episode.